Hey traders, welcome to Charts and Coffee. Hope everyone is having a good Thursday morning. All right, let's get to it. So we have the continuation, slightly continuation higher we had two big hot zones this morning, by the way, in the aftermath of the ECB. The presser began at 8:45 a.m. Eastern. And then we also had the hot zone of, take a peek here, the core PPI and the PPI both came in a little bit hotter than expected. Both were actually revised downward from the previous. So in terms of whatever reaction we're ever trying to glean from these hot zones, just take a look at the price movement at the time that they're released. Don't worry about what was expected. I mean, we'll take a look at that eventually, but the initial reaction is, was it bullish, was it bearish, or just a lot of volatility? When we take a look at the S&P, look at all this chop that preceded the 8:30 hot zone. This is pretty much what we've been doing all morning long, right? We go up to the hourly price movement range resistance, we go down to the hourly price movement range support, and back and forth. So nothing new, right? We did not even punch down to a lower low than what we saw at the Asian close. And, really nothing new. We just continue to chop around. But it is important to note that that chop is sitting above the previous session close. So we're chopping around in a bullish way because we're trading above yesterday's cash close. So I'll look at that as frankly bullish sentiment. And then if I step back and also look at the daily time frame, this is another reason I would not want to be bearish. Look, I haven't been bearish all year. There have been almost 9 completed months this year in 2024. So let's just take September out of it because we're only halfway through. So 8 completed months, right? Of the 8, 5 were up months, right? So the idea that this is, some sort of harbinger to a downside, the idea that we should be preparing for significantly more down, this has been part of the narrative of 2024 all year long. So apart from stating the obvious, which is it's not only wrong, the problem with that kind of analysis, I mean, everyone can have their own opinion, even when it's as blatantly wrong as being bearish. But here's a problem. It's an opportunity cost, right? So missing the first 3 months of the year and probably some of the best uptrending movement we've seen since likely 2020, 2021, missing the late May to mid to late May to July. It's another stretch of an uptrend. Yes, we've got some chop right now, but we've completely eradicated the end of the world sell-off. Remember, for about a week, we could not turn on television and not hear about the unwind 2.0 and how much more money had to be taken out of the carry and everything else. But here we are trading right back to where we were before that time, which tells you that was an anomaly. And had that not been a thing, and so heavily, arguably, overreacted to, we'd still be moving sideways from the July range. So please remember that there are definitely still strength plays to be had, but they're not necessarily going to be in the places that we've been talking about or want to trade, which is Magnificent Seven. I mean, I'll tell you right now, who cares? Who cares about the Magnificent Seven right now? They're actually not the Magnificent Seven. We should actually have a roster, right? That Magnificent Seven should be able to be replaced. It should be like Menudo. They need to replace those things, right? What's magnificent right now? Coke, telecommunications, healthcare. Even some financials have been pretty stable despite that Basel III conversation that happened earlier this week and kind of upended some of the financial stocks, big banks. There are places where things are really strong. Utilities, right? Feel free to say, look, this band as it is isn't working anymore. We need to replace the singers. And if we don't do that, if we don't go into that watch list building process of ditching what isn't working anymore, we're always going to be looking for, what is NVIDIA going to be doing next, or what's next for semiconductors, when in reality, it's just not their time, right? And this is probably one of the most difficult things when we're looking at a path to account growth, right? So if I look at a path to account growth. The number one thing is what I'm talking about right now. And that is, what are we trading? What are we focused on? What has our attention, right? And if we get that part wrong, I don't care what kind of strategy follows. If I don't get that part right, I'm not going to get follow through. And without follow through, I'm not going to get account growth. Now, one thing I do want to mention, I did mention semiconductors because I know a lot of folks are interested in semis. Yesterday, we finally got a yellow neutral candle. This is an important step towards possibly getting a little bit more bullish sentiment above the equator. And there's probably two levels here I would want to point out. There definitely is. The anchored VWAP for the year and the white dots that are the equator. Imagine a bullish and bearish hemisphere on every chart, 5 minute, 1 hour, daily, weekly. Are we above or below that bullish hemisphere? And we can see we're making our way above it and we're going neutral. So then you might say, okay, Rog, then what do we do with that? Does that mean it's time to start getting into semis? Well, here's what we want to do. And this is watch list building 101, gang. And this is the kind of stuff that I'll be talking about on September 24th. You're saying, okay, Rog, this sounds reasonable. What I trade is pretty important. I think we can all agree on that. But what have I been trading through August? Right? I mean, in August, we outperformed the S&P. What am I trading in September to be up so far 12 days into the month to what we're choosing to trade? So here's the first step. Find out if something's out of, at least for now, that bearishness. Semiconductors might be pretty early, but worth keeping an eye on. Now let's take a look at relative outperformers within the semiconductors. And I would say Taiwan Semi, AVGO, TXN could be a really interesting one. AMD, I'd be cautious, but it's worth a look. TXN is actually the one that I like maybe the most off that Darvis level. So let's keep an eye on that. That could be a really interesting one if we want to venture into potential outperformers in semiconductors. So you get this process right, life becomes a whole lot easier because you're not fighting trends and you're not hoping for follow through. You're in a spot where that train's already heading down the track. It stopped at a station and you hopped on, right? Okay, so let's see, a couple questions in our essentials room. Bear with me. As far as the hourly price movement ranges on the hourly, or make sure, so why are they not showing up for you on the daily? Remember, you need a daily price movement range for the longer term time frames, and we use the hourly price movement range for the shorters. They're two different zones. You'll notice I've got gold and gray zones on a 1 hour chart, on a daily chart, and I've got the red and green zones on the 5 minute chart. The red and green are the hourly price movement range. So that's how you distinguish which one I'm using, right? Look at that color. The red and green are the hourly price movement range, and the gold and the gray are the daily price movement range. And there's a reason we differentiate between the calculation of those historical volatility ranges depending on the time frame. So we want to make sure we're using the right one for the right job. All right, next up is, let's see, questions. Good morning. Good morning. Good to see everyone. All right. So I'm looking for some questions. Not yet. Okay. Let's take a sip of coffee. All right. And take a look at the NASDAQ. So we did a bit of a little dive on the ES, little deep dive on the ES. We said we've got those green candles. Do we have it on the NASDAQ? We don't, but at least we're out of harm's way with the red. Now I say out of harm's way because I still want to be bullish, gang. I still want to be bullish. And ultimately, the reason for that is when you take a look at the overall trends in a number of the sectors, you take a look at the overall trend of the indices, you take a look at where we are in relation to the equator, we have yet to stumble into that bearish part of the chart, which is at this point, that would be south of call it 18.3, right? Notice how when we do have these dramatic sell-offs, look what's there to catch it. It just works, right? Those white dots, the equator, it just works. We stayed in the bullish hemisphere. So while there might be some short-term time frame setups to be bearish, bigger picture, it just makes no sense to try to pick a top in this market when it just continues to keep, for the most part, selling off and then moving back up. And that's a concept that a lot of traders confuse with, and here's a really tricky one, and that sometimes it's tough medicine. Are traders out there? Ask yourself. I ask myself all the time. Am I bullish because I'm long, or am I long because I'm bullish? It should be the latter. Now, there's another one of this. This is coming, and that's straight from one of my favorite books, What I Learned Losing $1 Million. But let me take another variation of this, and this is a Ragheeism. Revenge trading, an uptrend, is a short sell. Looking for tops in an uptrend is a revenge trade because traders are not already long. If you're long already, right? If you're long already, are you looking for a top? Are you worried about the shoes dropping, or whatever, the storm coming? Or are you just going to continue to ride that trend until it runs into resistance? Remember, extreme bearishness is usually a reaction to not already being long in an uptrend, period. And if we're talking about certain events, and this is another one, at what point ever in time have we ever talked for a period of time about a particular scenario, and that was the scenario that caused the crash? I'll tell you how many times. Zero. Because if we're talking about it to some degree, it's been discounted. We're never going to see the reason for those major disasters coming, whether that was the yen issue that we had in early August, or whether it was the pandemic in 2020. So that's kind of the funny thing about talking about the reasons why we're going to crash. Those are never the reasons, are they? So keep in mind, if we're talking about something, right, like the inane yield curve conversation, right? If we're talking about it, it's not ever going to be the reason. It's the things we don't see coming, which is why we can never prepare for them. So we trade what we see, not what we think. And that continues to lead us back to, quite frankly, really, really nice uptrends that exist in places we usually don't talk about. Utility staples, real estate, healthcare has come on a lot in the last month or so. August was very good for healthcare. Even communications have been pretty decent, but mostly led by the telecommunications. So if you're looking at strength in the XLC sector, it's really not XLC. It's really more the telecommunications overlap in that ETF. But one of the things that we've been doing is getting long consumer discretionary. So this has actually been another odd little corner where it's not let's buy the NASDAQ, it's let's buy the consumer discretionary ETF. So these are things that we're doing in the sector secrets mastery. All right. So those are the kind of watch lists that we're building, right? Okay. So let's go ahead and jump into some questions. I see they're coming through. Awesome. Am I still in Pepsi, Jess? Yes. In fact, I'll tell you right now, this is what we have, and I'm happy to share it. There we go. Oop, that's a huge font. That's not going to be helpful. This is what we have in the mastery. Now, most of these prices, we've already dug our heels in and put on the trades far lower in terms of buying the calls. So this is from Wednesday. These are the Wednesday trades we have open. And yes, you can see there we had Pepsi. Now you're asking, we did hold, right? Yesterday, take a look at my closed swing trades. Now, if you're still in it, so this is what I wanted to mention. We bought Pepsi 20 September 170 calls. If you had a fill and if you had a scale out that was lower than 575, you might still be in, Jess. But you'll see here, we held it for a very long time. We went 355 per contract. So these are always per contract, and every single entry that I get into. If I scale in twice, both those numbers will be there. So when we measure our profit, it's never from the lowest scale in. How cute is that? It's always from every single part that we scale into. Yes? So if I go 355 to 575, 575 per contract to 950, if we drop back down below 570, I'm going to go ahead and get out. So yeah, we held that one for a really long time. We just closed it yesterday. But we still have Coke, we still have gold, we still have IBM. In fact, we just scaled out of IBM the other day at 905. So yeah, we're continuing to take advantage of the movement. I did have to cut one of my legs. So here's a really great example of how, if you are going to think about scaling in, how you have to think about scaling out. I had two entries on XLF. I had to ditch one of them. One of them was taking on too much water, and that was it. I had to get rid of it. But the other leg I was able to keep. So we have to think about each individual leg. I'm not averaging, right? I'm looking at each leg and the risk to the account each one represents. And if you're wondering, Rob, that's interesting. But how do you do that, or why do you even do that? Well, again, this is going to be a big topic over the next couple of weeks. So pencil in September 24, 8 p.m. You and I have a date, and we're going to talk about the numbers, the formula to account growth, what I've been doing in the mastery. By the way, we always only use the actual setups that we do in the mastery because that's where, we're always going to use the alerts as examples. And this is where we are right now. We got into RTX yesterday. And I'm trying to remember who in my mastery said, hey, we need to look at this. It might have been Ralph. So shout out to Ralph. That was a nice little move from $375 and $3.90 per contract. Now, also think as I'm mentioning these numbers, how many contracts could you buy if the option costs less than $400? 2, 3, 10, right? So that's part of that formula of account growth. And a lot of that goes back to sticking within parameters that A, can grow your account, but B, and more importantly, won't blow it up. And that's one thing I can talk very confidently about because I've never blown up an account. So I follow the formula, I follow the math. As far as Costco and Lowe's, yeah, let's keep an eye on them both. Lowe's is a pretty good one, although it can be kind of spendy. I've been leaving Costco alone. I haven't really trusted it or Walmart. And I will tell you, Jas, I think there are some better names in staples. Procter and Gamble was one that we really got interested in, but those are both great names. Now, Lowe's is interesting because it's going to be tethered to that home construction story too. So I like that one a lot. All right, next up is Maruf asks, are we all clear to Fed Day? I don't know what that question is. If you have a specific one, I'm happy to answer. Are we all clear? I don't know. You mean, are we going to keep going higher between now and the 18th? Are you asking me to predict the next 6 days? Not a clue, my friend. All right. Nobody knows, my friend. Nobody knows. Let's just trade what we see and stick with the trends. All right. How does ENG look for a swing trade? So Ren, I'm going to look at natural gas futures. That's going to map to UNG, or for some traders, they like BOIL. So if I'm looking at this, it's not a no. And we are above the VWAP, which is something we've struggled to do since obviously we dove below it back in July. I can't say that it's really super ready for prime time for me. It looks better than crude oil. Let's keep an eye on it. And then I'll also say, more than whether or not I'm ready to do it, Ren, I can't say it's high on my list. Let's keep an eye on it. Let's keep an eye on it. It's certainly at least more bullish than it was. I'd frankly like to see it get above 2.3. Yeah, I'd like to see it get above 2.3. That's what I would look at. So if we can start to establish support, and when we sell off, we bounce from that area, that would be a really interesting place to look. All right. Next question, last question for the morning is going to be from Mauricio, who asks CX. All right. CX. And is the bottom in? Probably not. I'm not going to guess. We never know when there's a bottom in. What's the pattern you're looking for? Right? I will say this is the most bullish thing I can say about CX, aside from the barrage of red candles. At least it's bearish chop, but there's no way to know. Not yet. There's no pattern that would tell me like a 1, 2, 3 that it's starting to form. I would say I don't know. And by the way, CX is a penny stock, or whatever you want to call a stock under $10. So what I would say, CX, if you're looking at something like this, I typically don't. So take that take that along with any advice that I'm going to be giving you about what I would potentially do. It's a volume game. When you start getting into stocks like this, sub $10 per share, start looking at volume and find out if you're alone at that price level or not. I would look at the year. I would look at the quarter. So anything under $10, yeah, take a look at what's going on there at the volume level. And right now we're below the equator and we're below the VWAP. Please be very, very careful. Yeah. And then wait for a pattern that typically you use for a bottoming cycle, and I like a 1, 2, 3. All right, gang. As always, thank you so much for being here for Charts and Coffee. I appreciate it. Follow the process, gang. It's never about prediction. It's just about process. That's it. I'll see you all tomorrow, same time, same station. Be good to each other.